Okay, thank you guys for coming today. As again, we do our trainings every Wednesday night. We have our back to basics. So if you are looking for case design, structure, something a little unstructured, so to speak, we do just breakdown of questions people have every Wednesday night, 8 o'clock Central. And then, today, which is Thursday at 4 o'clock Central, we have our sales ideas or product. And today, we're going to talk about advanced sales ideas, combining products for optimal solutions. Now, what's interesting about this is I often like to reflect on some stuff that I used to do back in the day. And for those who remember good old Circuit City, I worked at Circuit City back in the day as a tech manager. And sometimes I'd work in the TV department too. And people would come in and they would ask to buy those combos of the TV and the DVD player. And I would often tell people, I was like, well, why would you buy the two in one? Because if something happens, you have a broken DVD player, a broken TV, now you have to go and replace both. So I think of that same concept or same idea here when we talk about solutions and opportunities for combining different products for different opportunities in the insurance industry. And ultimately, it can give you a pretty cool edge on the competition, but also in perspective, when we think about the different types of solutions out there, they talk about sticky business. And, we think of companies like State Farm, Farmers, they sell you auto, they sell you home, and then they usually try and bundle like a 25K policy in there. And it's not because life insurance is cost efficient with any of these carriers, but the big benefit is it creates a sticky relationship. And when I used to work as a wholesaler, we would go to Edward Jones all the time for what we call regional support meetings. And they actually went through a whole exercise to say that if you want to competitor proof your practice, you want to get at least three products with that same client. Then you have about a 99% chance that they're not going to leave you. Same thing with like banks. When banks, have you set up with them, and then you can pay all your bills through there and it goes automatic. It's very hard to leave because you have to unwind a lot of things. So there's definitely a science behind the idea of combining products, and it can help achieve an ultimate goal for your customer. So what we look at here is by the end, you'll be equipped with some designs, some ideas to help tailor financial solutions that can meet client specific needs. So as we go through this, what I would hopefully, hear you guys figure out is I've got a client that matches that idea, or it can, spark some conversation for some different types of clientele that you might not be currently engaging with that you could engage with after we have this conversation. So we'll look at ideas that can involve multiple carriers, multiple offerings, and ultimately the beauty of this is this allows you as a agent to have that ability to diversify your portfolio, diversify your practice, and really, again, the end game is to make sure that the client gets the best possible product. So, why does combining products matter? We think about the idea of bundling solutions. As I mentioned already, the idea can create a stickier client, but with comprehensive protection, it does address multiple financial needs and it does create that holistic approach. So, if I offered someone one product with one carrier all the time, but yet I'm not a captive agent, you're I don't want to say you're being biased, but there is no one carrier and one product that fits everybody, plain and simple. So we want the idea to look well-rounded. Some carriers have a more cost-efficient approach, and so if you gave someone, say, a term policy with one carrier and a permanent with another, it might help, the client save some money. But again, the idea is that you're a broker for them. You're not a loyalist to the company per se. So again, that holistic planning idea strengthens the relationship with you and your client and ultimately increases revenue by offering different products. They have different comp structures, different ways that they're going to pay you, which we'll talk about here too, and really maximize your opportunity for referrals. Because at the end of the day, you do good for one customer, or I like to say you do good for the community will do good for you. I know that's not proper English. Um, so we'll talk about different ways, comprehensive protection, like bundling life insurance with some chronic and critical illness riders. A lot of carriers have those built in now. Some we can even talk about adding, riders on there for dollar reduction. Maybe wealth growth and security to the extent of pairing permanent life insurance with annuities or other investments, legacy planning like long-term care and chronic illness, and also in the business world. So if you guys aren't working with business owners, that's a double win right there because a lot of times people have business needs, but then they also have personal needs. So if you can address and help them on the business side, it opens up the door for more possibility for them on the personal side, as well as their employees. So we want to look at the goal. What is a short and long-term goal? When understanding our clients' needs in this bundling opportunity, gauge the comfort level on investments. So it doesn't hurt to ask someone what their monthly budget is or annual budget, because a lot of times, depending on the person, I might not go all the way up to the max budget because things can change. You want to review the coverage, so identify the gaps and opportunities in their financial plan. We have a financial needs analysis, document. It's not an Excel sheet, but it helps you and your client understand where the gaps might be, where they might be spending a little too much, and ultimately how you guys can come up with a solution to meet their ultimate goal, which most of the time people are looking at is retirement. And then ultimately looking at the flexible, scalable solutions to give them the right need at the right price. So we'll spend time here now looking at different ways to, position certain sales and how you can combine them together. First and foremost, we'll look at the young professional who's kind of planning for the future. So this would be your type of clientele who would be ranging between late 20s all the way up to say mid 40s. Because when you think a young professional nowadays, people are starting to work in their late 60s, early 70s. My dad himself is 71, and he still thinks he has a couple more years in the tank to work. So that's why I say when you talk young professionals, someone who might be like 43 is still considered young, and I'm gonna stand true to that and hold true to the idea that I'm still young. So, but what are some of the challenges for young professionals for the future? Managing debt is a huge one. Whether you have kids or not, that can always add to the mix. If you're managing debt, say you have some credit card issues, or are living above your means, which is usually, a situation with credit card issues, that usually means savings is out the window, and insurance is not really a first thought because a lot of people will try and just snowball everything and get out of debt. So, if we have an idea here, the solution that I'm going to propose is a three-tier approach. We want to protect against early death. We want to protect against getting sick or disabled along the way. And ultimately, the opportunity to help them start incrementally saving to get them moving in the right direction. This will create a balanced financial security or portfolio with that long term growth potential that the client can add money to later if they want. So, what I did first is I explored the idea of, let's say, for example's sake, we have a 43-year-old male, like I said, very young, but only making about $50,000 a year. So, that's still a great salary. People can live off of that, no problem. And when you think about that, that's roughly $4,200 a month, give or take. And so when we look at $320 per month, As a budget, if I just do the simple math, 320 divided by 4,200, that's about, let's say about 8% of their total take home is what we can do to work with a plan like this. So first and foremost, I think one of the biggest areas that we neglect is the idea of true disability coverage. Now, a lot of people that I know would talk about term insurance that has living benefits like chronic, critical, terminal, and tell everybody that they can simply just cancel any disability policy that they have because this will cover them against things like chronic and critical illness. Now, if I was a doctor and I was a heart surgeon, for example's sake, and my hands started shaking, well, I can still perform other jobs like a teacher or, something else, but the chronic and critical illness from a term policy wouldn't cover that. Disability would. So there is a benefit to a true disability policy. And if you look here, for a $50,000 annual salary person, I can give them roughly $35,000 in tax-free money for a total of a 5-year benefit to help them get back on their feet in case they can't perform their job requirements anymore. You think of the business professional like carpal tunnel syndrome, maybe they can't type anymore or have some other type of issues which not allow them to work in their specific field anymore. Maybe they talk on the phone all day and all of a sudden something happened to their throat and they can't talk anymore or as well as they used to. So things like that are not covered with chronic or critical illness riders, but for a very cost efficient price at about $62.38 a month, that's very dirt cheap. Now, if you think about it, if you talk percentages, the 62.38 a month is roughly, let's look at the math, $62.38 divided by 4,200. You're looking at 1.4% of their take home income to give them roughly 60% of their actual salary tax free in case something happens to them for a total of 5 years. That's not a bad deal. And it will help people get back on their feet in case something happens to them along the way. Now, if you couple that with a term policy, I'm looking at a 43-year-old preferred non-tobacco for $500,000 for a 20-year term. So that would get this respective client to the age of 60, 63, and $500,000 for roughly $49 a month. That's also not bad. It does also have on top of it the chronic, critical, and terminal illness. It's the QOL product from Corebridge. So you have both a traditional disability policy plus what I would call an extreme policy for, major issues like heart attack, stroke, and cancer. And then we talk about, utilizing the rest of that money. So 62.38 plus 49, we're looking at about, $111. So then what we do is if we talk about adding in a third option for this young individual, we can do Roth IRAs, but simply $100 at minimum a month with National Life Group. So now you have a portfolio or a plan here that can combine three different solutions from three different companies. A surety on the left for the disability, you have QOL for the term, and then you have a Roth IRA for this young individual to start saving or at least putting some money towards retirement at roughly 8% of their take-home income. Now, again, going through a financial needs analysis, you'll probably realize that you can get more from that client, or they might like this idea and juice up the Roth, or maybe get some permanent insurance with some retirement income from that standpoint too. The reason why I like adding in the disability policy is a lot of insurance agents are overlooking the fact that with disability policies, not only are you protecting someone through their working years, but you yourself, the normal compensation for a disability policy is roughly 50% of whatever the, premium is. And then you get somewhere between 4 to 6% uh, per year in renewals for the entire duration of the contract, usually to age 65. Some stop at 10 or 20 years, but that's a big renewal base if you start building out a disability portfolio. And we have a team that can basically do all the disability work for you. They'll even go point of sale and help you out with that. So think about it from the standpoint, like I said in the beginning, when you have someone who goes out and just simply buys one product to think that it can fix everything, typically it doesn't. So we want to look at the scenario here of leveraging different products and different opportunities to give a client the best possible opportunity. And I will tell you this, for myself and everybody on this call, everyone, if I gave you 320 per month, would have a different case design if I said, hey, I've got a young individual looking for protection, retirement, go. Because everyone is going to have a different idea. And in 18 years of doing this, I've had not one client the same. And so there's nothing wrong with it. But you can say to me, well, Phil, do you have, dependents? Do you really need 500K in term? Maybe. I have two kids, they're 16 and 13. I've got a spouse. Maybe I want more term insurance, which would cost more. Could I reduce the amount going into the Roth? Could I eliminate the DI and just do the other two? Sure, there's no right or wrong answer, but I want to just open your eyes to the opportunities here that you could think about and put in place. There's actually also from Assurity, they have critical illness policies to pay out like 25K if you had a heart attack. If you had another one, they pay you another 25K. And they actually have a microsite I'll show you here real quick, where you can simply do it very, very quickly. So what I did was I looked at the disability income. I said, get a quote. I said, I'm in Tennessee. Get quote. Date of birth, 12/22/1981, in case anyone wants to give me a gift. Male, no nicotine. Let's just say we want to pay monthly. Next, what type of occupation do I have? Because any one of these will matter when you're going to get the offer. Labor is going to be more expensive. Professional, is going to be the least expensive. So if I hit next, and then let's just say my income, like I said, in that category was 50,000, you can look at three different options that they'll give you right here, right off the bat. So 6238 gives you 5 years of protection, 10 years of protection is 76, and then to 65 is 8748. So you have options that are right at your fingertips that you could look at and make an executive decision, or at least plot it out, is what I would say. So we stuck within the budget, $311.39. Could you add the other $9 to the IRA? Absolutely. But just giving you, a simple concept and idea here between the three of these.
I have a quick question.
Yeah,
For this disability one that we looked at, Assurity,
yeah.
uh, does the ratings matter?
Well, yes. I mean, when you talk about disability, it's a different animal because if you look at it, it's morbidity versus mortality. So they care if you have like shoulder surgery, whereas, life insurance wouldn't care about that. So, if, for example's sake, I had shoulder surgery, they could put an exclusion on the shoulder, but I could get an offer for everything else. So, it does depend on the person whether or not they can get that type of coverage. But it's all what I would say is when you ask for a quote, it's because we have someone who can do this, and I did a surety because I can do it real quick, but we have a team that will go through all the different carriers like Principal, the Standard, Emeritus, Assurity, and see which one makes the most sense. But they'll ask for name, gender, date of birth, occupation. They'll ask for their salary all in with, commissions and bonuses. And then they'll ask if they have any ailments or issues because that could knock them out. Um, so yeah, that would be part of it.
Thank you.
Yep. Is
Now,
health license needed?
I've got a question.
Yeah, Gloria.
On with the team, is it through three marks?
Yeah,
Okay,
all three
so
of these are through 3 mark.
okay, all three of this. Okay.
Yep.
And you said that you were quoting the term was with Corebridge, correct?
Yes.
Okay. And
Yep.
then NLG for the Roth. And okay, that's all I
Yep.
needed to know.
Good. Yeah. And Smith, to answer your question, you don't need a health license to sell DI. You need a health license to sell long-term care products. So
Okay, thank you.
no problem.
Because I was just talking to Sanjay yesterday, and he's looking for DI because he was going to look through work, but I said I'll talk to Phil and let you know. And glad we are talking about this today. So
Absolutely. Yeah, it's a huge benefit. And if you buy it through work, it's going to be taxed because work is going to, pay for it. But what will typically, and that, thank you for actually saying that because that's the other question. They'll also want to know, does the customer have any DI through work? And if they do, then at that point, they typically aim for around 60% total coverage. They'll say, hey, you can get a individual policy at 30% of total coverage because you have 30% through work or something like that. So that's the last question that I completely forgot. So I apologize.
got it. Thanks.
Yep.
Now,
Yeah.
Phil, well, this is nothing to do with this, but because I've got a client that's sitting on my desk right now that's looking for long-term care and a cancer plan.
Yep.
Who do we have for that? And I know it's nothing to do with this, but
Yeah. No, I mean it doesn't because like if I go back to this screen, right? And if we looked here, you can get an accident plan. They have a critical illness plan, which should usually indicate or also include cancer. So Assurity has a lot of these ancillary products if you want to go through them from the cancer side. So I would just say we'll keep it simple. You could go there, and I think Mutual of Omaha also has a cancer policy.
what is their income protection? Is that a
That's term.
hospitalization? Oh, that's a term.
Yeah, yeah, or that might be term. I don't know what income protection is. I usually only use them for the DI and for like the critical illness policies. I do know that if you have like a business owner, you can actually use Transamerica to do like cancer policies for the company. If it's like say 4 or 5, if it's over 5 individuals, it's guaranteed issue. But that's a different animal for a different day. So we'll just stick with this one for right now. But yeah, you can ask for a critical illness quote from a surety, or tell you what, I'll even put this in the link for you guys. So if you guys want to play around with it, you can. And why would I hold back on you guys, right? So dive right in.
Thank you.
Oh, no problem. So I'm here for. So kind of flipping the script and talking about business owners. Business owners have a very unique problem on their hands. The whole idea is to protect your business, right? So how do you protect your business and retain your top level executives? And we always talk about this. I'm going to talk about it in a more in-depth conversation at the Great Collaboration, May 3rd and May 4th. Wink, wink, in Dallas. And but the idea is we really want to make sure that we're talking to business owners and helping them protect their biggest asset, which is themselves, which is their business. And ultimately, if, for example's sake, because Gloria, you're the last person to talk, I'll pick on you. Say you're a very key person of mine, and I say, Gloria, I need you. I need you for 10 years. We're building this company. We're gonna crush it, but I am going to give you a bonus that I need to insure you to make sure that, you don't go dying on me. So
Mhm.
are you okay with that?
Yeah, it's fine.
Now, the normal answer would be, well, what's in it
Well,
for
why?
me?
What's in it for me?
Yeah, there you
Yeah.
go. Yeah. So, so that's when we talk about the deferred compensation plans. So we talk about a different way of positioning the asset of the LIRP, the life insurance retirement plan. But in doing so, you give them the protection they need, plus the comfortability of knowing that they're getting some type of bonus. So as I mentioned, you know, for Gloria here, well, let's say I work for you now, Gloria, and you're giving me this bonus. Okay.
That sounds
So
good.
I appreciate it. Thank you so much. You're so kind. So in this scenario, Gloria is going to bonus me a total of $20,589.30. If you see here, we're actually comboing the sale and we're doing a mixture of a death benefit. On the permanent policy, that is going to be my quote unquote deferred compensation plan. And then on the flip side is that, as Gloria mentioned, she only needs me for 10 years. Okay. So she's going to do a 10-year term at $1 million that if I were to pass away, she could put a collateral assignment on the term policy saying that that $1 million goes to her or change the beneficiary. Either way is fine. But the other product, the permanent product is mine to keep. I can name my own beneficiaries, which is going to be my family. But on the flip side is what you'll get from that is cash value, cash accumulation. So we're putting 20,000 a year away into this policy, or a total of 200K. And I am going to start distributions at 65, at 49, let's just say $50,000 a year, or a total of 1.25 or $1.245 million off of a $200,000 investment. So I'm feeling good as the key person. Gloria's feeling good because now she's got me locked in for 10 years. And she also has $1 million policy that if I, bite the big one, she's got that policy to keep her business in the black as opposed to in the red. And the biggest perk about that is every year she's giving me 20,589 to pay for these premiums, and therefore, that's a tax deduction for her. So you have an opportunity there to win on several aspects as a business owner to retain key employees, to protect your business, and also, really make them feel comforted.
How do you present this, Phil, to a business owner as far as I know that it is a tax write-off because you're giving it to them as a bonus.
Yep.
Um, and because it's for a life insurance, that 33%, does that come into play?
With 33%.
There's a 33% calculation on taxes when it's a bonus that you've got to take off the top.
Mhm.
Does that come into play when it comes for life, when it involves a key man insurance? Because it's life insurance, it can't be taxed.
Yeah, the you wouldn't have to worry about that because it just has to be a fair bonus.
Okay.
So like a good example, when I worked at AIG, I made before I went into the wholesaler role, I was a director, and I had like a hundred thousand salary, and they gave me a 20,000 bonus if we hit our numbers. So it has to be a fair bonus number. That's why they talk about key executives. It's not like your frontline people because that would be
Mhm.
pointless. It would be for those people that you can't live without, and it has to be a fair number. But yeah, I would say worst case, you'd always want to refer that back to your CPA or your wonderful accountant to make sure that you stay within the lines. That was my second major, and for some reason, the left side of the ledger always was off by a few pennies on the right side of the ledger. So I said, you know what? I'm going to go to school for sport management instead. So Sorry. So I know enough to be dangerous, but I also know enough when to punt, and now I'm punting.
What
So
kind of policy is this, Bill? I'm sorry for being late. Is this a key person?
what's that?
What kind of policy is this that we're looking at?
This is a key person
Key
policy.
person. Okay.
So yeah. So yeah, if you're talking business focus and business insurance. So the last case study we'll look at really is an older couple. Now, a lot of times in this industry, we love to talk about cash accumulation, cash value, benefits of getting tax-free retirement income. But between us girls, I would say your most profitable opportunity is with older clients and focusing on the death benefit portion of that scenario. The reason being is because older ages, higher numbers, things like that. But also, let's remember the key reason why we talk life insurance. Some call it the last love letter you leave your next generation. Some call it, the legacy plan. So when you think about older individuals, they're at that point where they probably have a fixed income. Maybe they're looking for a way to leave a legacy to the next generation, but don't want to deal with a major burden, during their retirement of trying to scrounge up money, or thinking about ways like maybe they have some side funds. If you see in the solution, they have some side funds, but they just don't know how to appropriate it the right way. So if we can offer them a solution like an annuity that gives them a tax-free benefit or that gives them a payout for the rest of their lives, ultimately giving a life insurance policy a premium, it can help them maximize their legacy. And so if what we did here is I looked at a scenario of an income, like a guaranteed income annuity, which will pay every single year for both lives, and a death benefit focused life insurance policy on a second to die. So why a second to die? Because it leverages your dollar farther than a
For the
single
younger.
life.
Mhm.
So if we look here and we run, say, a $200,000 cash, which is not needed, it's in a side fund. Maybe they wanted to give it to their kids, and they just want to keep it safe. Well, if we reposition that asset, so 12,960 would be the total number that they would get immediately guaranteed for the rest of their lives. And it would go on, but I just didn't feel like, putting multiple slides up. But nonetheless, you'll see the value even goes to zero and the guaranteed minimum value, but yeah, you're still getting 12,960. It's guaranteed no matter what. So if we took that same number and put it into a second to die, so what is second to die? Same thing here. You're getting cash until the second person passes. The second to die, the death benefit pays out at second death. So if we actually look at 12,960 on a 64 female and a 65 male preferred non-tobacco, we're able to secure $1 million in death benefit that will go all the way to age 105. And so if you look at, age, 85, 84, that's about $13,000 a year. So it's about $260,000. And you still have $1 million in death benefit. Average age of mortality is 78 to 82. So we're giving them a bigger and more leverage bang for their buck. And on top of that, we're able to secure not one, but two scenarios. So if you look at the advantage of doing the annuity, 200,000, let's say commissionable premium is anywhere between 5 to 7%, depending on the carrier. So we'll take the low end, 200,000 times by 5%. I know I could do it in my head, but I don't want to. So that's 10 grand. And then on top of it, this second to die policy is another, I think it was $16,000 in target premium. So when comboing the sale, you offer two solutions that can provide one, a value to the client because they don't have to think about it anymore. And two, it offers you a chance to get a little extra cash because you're finding a way to leverage both products appropriately. This second to die is with John Hancock. It doesn't mean you have to use John Hancock. There are several carriers, and depending on premium, depending on age, depending on genders, depending on, health, every carrier is going to be different. I found Columbus to be a good product for second to dies as well. But in this example here, I used Athene for the annuity, and I used John Hancock for the life insurance. But it doesn't matter. I mean, again, we want to talk conceptual versus specific product, because again, we can sell whoever the heck we want. So that's the perk and where we're at. There we go. So, what I would say is, oh, no problem. So what I would say is, when you look at these strategies, it does reinforce value. When you look at what you're doing, and when you share success stories, testimonials to highlight real benefits, as you sell these products and solutions, it engages other clients because, plenty of times I've told people, like, hey, I've worked with high net worth people. We secured $100 million for a big client, and so now all of a sudden, other people from the estate planning world are like, okay, he's credible. So you have these success stories that can help you benefit as you continue to move on. Conduct regular policy reviews. That's the hidden gem right there. A lot of people in our industry kind of set it and forget it, but this is kind of the industry where the more you stick with your client, the more engaged you are, the more opportunities you get. Because if you do a policy review every year, you check on the policies, make sure everything is kosher, they like what they see, they're going to refer you to other people. And every time you talk to them, it's like, hey, is there anybody else you think would be of benefit for X, Y, or Z? So there's always a reason to go back and do a policy review, even if it's term insurance. And that really deepens the relationship. You can celebrate client milestones like they hit the retirement goal they're looking for, and just stay in front of them as things change. Our business changes so much that there's never a reason not to let people know of updates that are happening, and maybe in the tax perspective, updates that are happening from an estate planning perspective, depending on the type of clientele, with changes in government, cause changes in taxation, cause changes in how we engage people, and may have to flip the script from what we were doing for the last 4 years. So you just never know. So again, measuring success in bundled sales. If you think about the product penetration rate, what we talked about in the beginning is if you sell 3 products or more to a client, you're really competitor proofing your practice, because when you sell 3 or more, then you have a 99% chance they're going to stick with you. Client retention, again, that whole idea of the penetration rate leads to retention, tracking long-term loyalty driven by these bundled solutions. And they tend to be happy. You have various options to provide to them. And just because we're talking today about bundled solutions doesn't mean every case has to be a bundled solution. Okay, so don't go bananas, but it's just an idea to think outside of the box, with different type of solutions that you can engage your customers with that maybe you didn't think of before. And I think that's one of the most important things as to why we do stuff like this, is to make sure that you guys are aware that there's plenty of opportunity out there. Best practices, for advanced sales, we talk about education. So never hurts to, some people that I know in different industries would actually do like around Thanksgiving time, they would give a pie to each one of their, customers. And, they would give a little insight and information. Everyone loves the pie, but it also gives a touch point to talk to them again and think about stuff like that. And you could even give little updates and hints when you talk to them at that point, or develop a newsletter. I have one obviously for you guys, for these meetings and things like that. But there's plenty of stuff that's happening that you can always set up a monthly newsletter to your customers. What I would say is if you have a CRM system that you can utilize for that, we have one if you don't. It's about 197 a month, and it would allow you the opportunity to set up newsletters for your customers and really stay in front of them very easily. Stay informed. Like I said, plenty of stuff is changing in the industry, and we want to just make sure that we're always staying abreast of it. And always client first. You know, people can smell commission breath, and you know, when they do, they're likely to flee from the conversation. And really, what we want to do is build trust, educate our clients, build trust and rapport, and that goes a long way. So I think I've kind of beaten this to death, so I'll skip the key takeaways. And just really want to open it up for questions. You know, I know this is probably one of the shorter presentations. Well, it's 45 minutes. It's still good. Does anyone have any additional questions on this or maybe even anything else? I'll give you a second to think about it. What I'll do again is just for those who came in, you know, a little later, I want to again encourage you guys schedule to come to the Great Collaboration in Irving, Texas. It's about 10-15 minutes from DFW. It's at the Westin, May 3rd and May 4th. It's a day and a half conference. It's only $25, and you're getting breakfast on the Sunday and you're getting lunch on the Saturday. So we're actually feeding you, and you're also going to get great speakers for those ladies out there who you know, got in the financial services and, you know, sometimes question it. We're going to have Judy Hoberman coming. She's author of the book Selling with a Skirt about women empowerment. And for us as men, we have to get with the times because a lot of the assets are going to be shifting over to women over the next 10 years or so anyway. So it'd be smart for us to listen as well. You know, I'll talk about estate planning. We'll talk about business strategies. You know, I'm up here right now in Indianapolis for the NFL Combine. So my business partner Roderick is going to talk about name, image, and likeness, or NIL, and how it's a $2.5 billion industry and how we in the insurance industry can actually participate in that. We're going to have tech there, like tech solutions. So I have some software that I use now, like Annuity Genius and Insight for getting quotes done quicker. We'll have demonstrations from them there to show you guys how advantageous it is to, you know, get stuff done quicker. And ultimately, it's just going to be a great opportunity to knowledge share, grow. So tgcconference.com. I'd highly encourage you to come and you know, see what we can do. But seating is limited, so sooner the better. It's $25 now. April 1st, it goes up to $100. So just giving you that heads up. Texas sounds like a good place of vacation. Yeah, Vince, bring the family. But it's gonna be great. Um, how late can we decide? So the later you decide, I would say the one concern would be is either tickets could potentially run out, or you know, they're going to go up in cost to $100 come April 1st. So I know us in the insurance industry like to procrastinate, but I would rather ease my own nerves and tension for getting people to register now so I don't have to wait to make sure that this place gets filled up. We have about 380 seats, and we have about, I think, 50 seats sold so far. So, but they are going quick. We just literally started advertising on Facebook this week with ads and stuff like that. But I'd rather the friends and family people ish come in first before, you know, randos come in. But yeah, perfectly said, Gloria. Don't wait. If you snooze, you lose. So if you come to the conference, I can assure you we can double your income because there's that much good stuff. And it's in Irving, Texas, or basically Dallas. So if you go to this website right here, it'll have all the information, and the conference stuff is all right here. So would love to have you guys, and really just create some really good memories. So I don't see any questions revolving around the information here though for the what we just talked about. I will be uploading it to the YouTube channel. If you don't subscribe, at Valor Financial. And we have like our back to basics. We had a really good conversation last night about standard loans versus par loans. And all my videos are uploaded here. So you have a giant repository of different things to excite you in the insurance industry. So, feel free to jump in. Oh, Gloria, the check's in the mail. Thank you for that. Um, but yeah, so all the stuff will be uploaded here. So if you guys have any inkling that you want to go back and revisit it, I should have this posted no later than tomorrow morning for what we talked about today for those who came in a little late. But just again, I want to say thank you. I hope you guys have a great rest of your day today, tomorrow, and a great weekend. And we'll see you either Wednesday night, 8 p.m. Central, and or Thursday next week at 4 o'clock Central. So you guys have a great rest of your day.
Thank you, Phil. Appreciate you.
All right. You guys have a good one.
Thanks, everyone.
Yep. Bye.